Hello everyone. In this lecture, we shall be discussing Chapter 3 of AFM Advanced Capital Budgeting Decisions. Capital budgeting was already covered at the intermediate level, but however, we will see what we have ignored or what all simplifications we have done in intermediate while deciding capital budgeting decisions. So let us start with an example. We are asked to find the NPV of a project. The initial outlay is 40,000. Annual revenue is 30,000, but we also have to incur an annual cost of 10,000. The useful life is for 4 years with no salvage and a tax rate of 50%. We are also given the discount rate of 12%. See, in this example, first let us compute what is the annual a revenue of 30,000 and an annual cost of 10,000, 20,000. Now, is this the profit before tax on this shall I apply the tax rate? No, we should also consider depreciation. 40,000 being the total investment, or let it be a machinery or an asset. So we are going to buy it and the life of which is for 4 years. So depreciation will be 40,000 divided by 4, which is 10,000 per annum. So if I reduce the 10,000 from here, my profit before tax will be 10,000 and tax at 50% will be 5,000 and my profit after tax will be 5,000. But this depreciation is a non-cash expense and hence to find the cash inflow profit after tax, to that you have to add back the depreciation, which will be 5,000 plus 10,000. Hence, every year I'll be having 15,000 as the net cash inflow from this project. If I purchase this machinery, every year I'll be getting 15,000. Now we have already studied what is the discounted cash inflow in intermediate level, right? So 15,000 for each year, I should be computing what is the discounted cash flow. For that, at 12%, what is my discount rate? Sorry, what is my present value factor? Each year I should compute 1 divided by 1 plus r raised to n and then multiply that with my cash inflow to compute the discounted cash flow. So it is already being computed here. If I multiply each present value factor, which is 1 divided by 1.12 raised to the power of number of years, this will be my final discounted cash inflow from this project. So the initial investment of 40,000, my net present value, which is net value, will be minus outflow. So 45,560 minus 40,000 be 5,560. This is how we would have done in our intermediate level when a capital budgeting decision had to be taken whether we should purchase this machinery or not. And finally, we end up saying this machinery has a positive net present value and hence we should continue to buy this, or it is perfectly fine in making this investment because of the positive NPV. Now let us see what all we ignored. What all are the factors which we have overseen in our intermediate level? The first thing is what we have assumed is this annual revenue and annual cost of 30,000 and 10,000 will continue for all these 4 years. But is it practically possible? Let us assume this annual cost is a labor and this person is working in this company and he's an employee of the company and we are paying him 10,000. Will it be the same 10,000 we have to pay for all the 4 years? No increment in salaries? Basically, we have ignored inflation. The product which I generate from this company or from this particular machinery, the selling price of that, would you think it will be the same for all the next 4 years? No. There will be some inflation factored into that, and the selling price will definitely be increasing, at least in line with the labor cost. So both the cost as well as the revenue from this particular machinery will definitely increase, at least considering the inflation. So we have overseen inflation in this whole process. We have taken the same 15,000 every year. Second thing, we have assumed that the tax rate will be 50% across all the years. But we all know every year our finance ministry will come up with a budget, and definitely there has to be some change in the tax rate, or it is possible that there is going to be a tax rate. So, as we took an assumption for simplicity that the tax rate will also be the same for rest of the years. So, the second point is we have ignored government policies or tax rates. Now, let us take the third situation. So, we have also kind of assumed in this example that once this decision is made to buy this machinery, there won't be any technical improvements, there won't be any need for any change. So basically, we have also ignored any change in it may also occur once a machinery has been implemented that it is required to align with new technologies. We may even have to sell the whole machinery because some improved machinery with a better facilities are available in the market. All such uncertainties we have ignored, and we have assumed that this particular machinery will be the best machinery in the next 4 years, and it will be continued to use. So these are the three things which we have ignored or we have assumed that won't be changing for simplicity in our intermediate level. And in final level, that is why we call the chapter as advanced capital budgeting, wherein we are not assuming that these things will change, or at least we are factoring in how to consider these things when it comes to taking a capital budgeting decision.